Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on April 14th. My name is Ian Saunders, and I'm joining as well here with Will Gibson, back in the office. Good to be back here doing a podcast across face from face from one another. I think we're on our 899th podcast from Dorsey Wright is this week. So 900 is coming up soon, but it's certainly kind of hard to believe that at least the firm has been doing it for this long.
There's some stat out there, I'm sure, that we could try to dig up about how long financial podcasts have been going. This one I would garner is one of the longer ones, probably one of the quietest and least well known, though.
Right. And maybe it was, and gone in ebbs and flows of being well known or less well known. And we certainly don't, not lucky enough to have Tom Dorsey banging the table here anymore. But right. We'll be sure to get him back on the podcast, at least in the near future. But at least for the time being today, since we didn't have a podcast last week with the market holiday that was on Friday when we normally release the podcast, we didn't get a chance to talk about how things did in the first quarter of the year, right? And so we had a lot of content in our daily report throughout the course of the past week or so, just reviewing what was strong, what was weak, what moved around throughout the first quarter. And I mean, at least a good thing, right? The SPY from a total return perspective up over almost 7.5% over the 3 months of the year. That was certainly saw some rocky movement over those 3 months, a little bit of up and down action. But there were some pretty consistent themes of leadership that played out throughout the 3 months across a few different asset classes, right?
Yeah. And we'll jump into all of those today. But to be explicit, like three themes that we're going to hit on are going to be the mega cap growth outperformance, internationals continued outperformance, and then commodities picking up strength again with some focused areas in there. So those are some kind of three things that we're going to orbit around today. But maybe, Ian, we can start with like this all ETF performance table. We'll throw it up on YouTube. And for those that are readers of our research, we put this in the report earlier. It just frames our discussion today. You get a bit of the international flavor in there. Mm-hmm. You see a bit of the mega cap growth flavor. And then on the downside, you see some of the commodities action as well.
Yeah, certainly. I mean, you say a bit of mega cap growth. I mean, in that breakdown, we're looking at top 10 performing ETFs for the first quarter of the year, and then the bottom 10 performing ETFs, right? Out of the top 10, 9 out of the top 10 were kind of mega cap growth oriented areas. Well, I guess 8 out of the top 10, because Ethereum was kind of the best performing representative there, up 80% over the first 3 months of the year, looking at ETHE. So we didn't want to spend a whole podcast just talking about Ethereum. So kind of looking at some other areas.
To be honest.
I mean, there's been a lot of action in there. 80% is certainly a lot to talk about, but I mean, there's a lot of that mega cap growth in there. You have a couple ARC representatives with some of their Web X.0, semiconductors, technology. I mean, just a lot of that mega cap growth, and the Qs made their way in too, right? I mean, you had the S&P up 7.5% on a total return basis, and the Qs were up over 20% on a total return basis throughout the first 3 months of the year, which, I mean, that's that outperformance from growth, mega caps and Q specifically. That was the name of the game throughout most of the past 5 years prior to the kind of 2022 environment, right? I mean, you saw technology and mega caps leading the way throughout much of that time. And after a period of pretty sharp weakness last year, they've seemed to bounce back and have a pretty strong 3 months.
Yeah, that's a good point about them being in favor for so long, and then they weren't, because last year was certainly the latter in that they were not in favor. So the first quarter of this year, there could be some mean reversion contributing to that degree of outperformance. I know we talked about the just magnitude of like NDX or the Q's outperformance over even the equal weighted S&P 500 or even relative to small caps. Just the mega cap growth, tech, consumer discretionary, absolute just shadowed the little guys by a historic margin. So certainly, I think some mean reversion going on there. I think maybe falling interest rates also aided some of the mega cap growth counterparts. Rates really started ticking down over the last end of the quarter. And then maybe there was a bit of flight to safety going on there as well. Most of these companies are established, proven leaders in their industry or particular sectors.
Yeah, absolutely. And I mean, you talk about some of the shifts in leadership, right? I mean, within the Dolly rankings that we have, right? Technology had fallen from being one of the top ranked areas in that Dolly sector breakdown for most of the past decade, kind of leading into the 2020s. And it fell down kind of pretty low in those rankings, down into ultimately the 9th position out of the 11th areas. And then from the end of, and so it sat in that 9th position at the end of last year, right? And in December 31st, 2022 was at ranked 9th, with only 93 RS buy signals in that breakdown. It gained enough relative strength to move back up in the 2nd ranked position over the course of the past 3 months, which the only other time we saw it gain that many buy signals in one quarter was the first quarter of 2009. So, I mean, it's a pretty notable improvement that we saw for technology. I mean, it's now ranked back 2nd in the rankings behind basic materials, slightly ahead of industrials. So we saw that reflect in some of the other kind of models we have on the platform, picking up a little bit of technology exposure. One of those main areas of strength have been semiconductors. I mean, you have one of the stronger performing representatives out of the all ETF performance breakdown. You saw the VanEck Semiconductor ETF, ticker SMH. I mean, it's a pretty sharp looking chart. It's up 23% on a year-to-date basis now. 5.88 fund score out of 6. I mean, that's pretty darn close to perfect, right? Mm-hmm. Not quite there. But 4 consecutive buy signals, and it's not too heavily overbought at current levels either. I mean, you've seen that kind of steady, consistent improvement. It's consolidated a little bit over the course of the past few weeks, not quite as sharp as we saw in January, but I mean, it's good to see that little, you don't want it to continue being so sharp because then you get into such heavily extended positioning, right? Yeah.
Yeah. Or you get a stock that looks like NVIDIA that went up 90% in the first quarter. That was the best performing stock in the S&P 500 by like 15%.
Wow.
I know we were talking about before, it's down about 9% since then, but speaking to your semiconductor strength, that's a big guy in the sector that certainly helped that space along.
Yeah, I mean, that showed, I mean, that 90% would not be too shabby for 3 months. I think I'd take that.
No kidding. No kidding. Yeah. So what else you got? Mega cap growth, any other themes, takeaways there before we move on to our next point?
No, I mean, I think it's just kind of speaking to that consistency nature, right? I mean, you wouldn't expect, you wouldn't expect it to continue on the same level of growth that it would have maybe. So you want to get that kind of more consistent consolidation. We've seen a little bit of consolidation across some tech names over the past week. And then you come in today and you have the Nasdaq up another %, right? I mean, so it's good to see that kind of consolidation and movement higher. So just kind of keeping that in mind as we move into the second quarter, I think would be ideal.
Yeah, fair point. Big inhales can require big exhales. So yeah, completely reasonable. Cool. Do you want to go to international outperformance next?
Yeah, I think that, I mean, so international still ranks at the top of the Dolly rankings, right? And we mentioned most of the representatives in that kind of all ETF breakdown are going to be more on the domestic equity growth side. But Mexico snuck its way in there.
Shout out to Mexico.
There you go. The iShares MSCI Mexico ETF, ticker EWW. Was up pretty solidly there in first quarter, up over 20% again. And Mexico has been a really consistent name, a really consistent leadership representative in stuff like our NEW country index matrix ranking, right? I mean, it's been ranked in the top 10 out of 42 countries in that matrix for well over a year. It's the only name that's currently in the top 10 that has been in the top 10 for more than a year. So, I mean, we see strength in Mexico has been a really consistent theme. But that's been about the only consistent area within emerging markets. Other than that, you're looking at consistent leadership from a lot of the European developed market specific representatives. Some other emerging Europe has come into play, but Europe's really kind of been the name of the game to look toward on an international equity space. I mean, you can see stuff like the Spider Euro Stocks 50 ETF FEZ 5.96. Fund score. So we thought that 5.88 was good. 5.96 is just a little bit better, just a little bit closer to perfect, up 18% on a year-to-date basis. So not quite the same level of improvement, but it's a little bit more consistent there from some of the broader European space.
Yeah, and you see these areas performing so well. I think we've been pounding the table about this for a while, whether it's the Dolly changes, whether it's the asset class group scores, whether it's just us talking like this on podcasts. But for whatever reason, we don't get as many questions about international equities. Even I think mainstream financial media is not talking about international equities as much as we were chatting about before the podcast. They've come into favor before, and then that faded pretty quickly.
Right.
Came back into favor, faded again. So it doesn't seem like there's a lot of euphoria or aggressive buying around the space, which could end up being a pretty decent tailwind where you have too many people on one side of the boat flips. So it really doesn't seem like, at least this is anecdotally speaking here, that people are piling on.
Yeah, I mean, it's not the flashy areas of international equity markets that are really carrying it higher, right? I mean, before, if you had China's showing a bunch of improvement. I mean, we've seen in the rankings, China can go from last to first pretty quick, right? Brazil, similar deal. It can go from very low in our rankings to up toward the top with some other Latin American areas pretty quickly. But when you get into these kind of developed market European areas, I mean, they showed a lot of strength in the kind of October into the end of the year, and then a lot of strength in the first 3 months. But it's not that kind of flashy strength that you might expect from the past decade that for international equities. So, which at the end of the day is a good thing for the asset class. Right?
Yeah, no, that's a great point. I think something else that was probably helping the space has been the falling dollar, falling US dollar. That's been a big theme that has been talked about, has been picked up a fair amount. That downtrend on his point figure chart's been pretty clear for quite some time now. So I think that's just an additional tailwind for the space, maybe becoming a bit less sensitive now, given that downtrend is a bit more established, but still likely a nice tailwind for the asset class in the first quarter of the year.
Yeah, absolutely. I mean, that's going to help out many different areas from the international equity side, both in the developed market and the emerging market side. We do see historically the falling dollar does tend to help out emerging market areas a little bit more than developed markets. But that at least hasn't played through over into the course of this year, looking at broader representatives like EFA versus EM. EM's seen a little bit more weakness from China, given its really high weighting in that representative now. So just something to kind of keep an eye out there for. If we were able to see the dollar lead to a little bit more strength to the upside for some of the emerging market areas, I mean, that's only going to carry the asset class higher, right?
Makes sense. Cool. Last point, commodities.
And talking about dollar, I mean, it makes sense to talk about commodities too, right? You have a lot of the tailwinds that you see take effect for some of the strength in international. I mean, that's going to carry right over into the commodities. We also see the falling dollar environment typically lends itself pretty well into strength in commodities, which did not happen in the first half of 2022, right? I mean, that theme played out in the opposite direction. Rapidly rising dollar and rapidly rising oil prices that really carry that commodities class higher.
Yeah, there was some interesting dislocation for sure when it came to the US dollar and commodities, select commodities in particular. But even with crude oil, like you saw some dislocation between crude oil falling and then energy equity still hanging in there. So there's definitely the scenarios where the norms and the generals don't apply to. But overall, you're right. Falling US dollar typically helps commodities. Commodities being priced in US dollars being kind of the rationale there. I think over the past quarter, you have to talk about precious metals. Gold in particular was all over the top of our leaderboards. Plenty of chatter about that on FinTwit, on financial media. I know I was looking at GLD before we started talking today that it's near its all-time chart highs. I would say within striking distance. But silver, not as often talked about, has actually been performing better than gold lately. So to put some numbers behind it, like GLD is up 10% year to date, which is still fantastic for gold. Silver is up 6.4%, so trailing in year to date. But if you just look at the past 30 days, gold's up 5%, silver's up 17%. SOV that is. So
for the past 30 days.
Yeah, past 30 days. So not as heavily talked about as silver, but still within the precious metals camp, performing very well.
Yeah, I mean, you can see that displayed on like the chart of SLB, right? I mean, it's up 6%, up 17% over 30 days. I mean, that means it had to have a pretty big drop, right? I mean, you can see that it showed consistent improvement, 2 consecutive buys, reached some resistance point at 2250, fell right back down to its bullish support line, that positive trend line. Passed that test, bounced higher, and then skyrocketed back up to complete. So that wouldn't technically be a shakeout pattern by any means, because we saw many more column of those broke through the support. But you can see, I mean, it just broke down, hit that support level, and skyrocketed right back higher. I mean, so now it's back in overbought territory, but it's up. That's a 17% over 30 days is certainly not too bad for SLB there.
It's a picturesque trend chart. We're gonna have to put that in a presentation.
Yeah, absolutely. It shows that positive trend line pretty definitively there.
Yeah. But again, overall, I think the main themes that we wanted to really hit on was that mega cap growth, international continued outperformance, commodities doing well, precious metals in particular leading the charge there. I think maybe some parting shots on commodities, then we can go ahead and land the plane. Crude was weak for most of the quarter and then more recently broke out, is at a pretty key level of resistance now, or it's around that $83 mark. So should you get a break of 83, that could help the commodities asset class as a whole. We talked about Dolly a bit today, commodities moving up. into what is the second position now, right behind international. So I think crude playing a decent role in that, or energy commodities as a whole. But natural gas for the past quarter was a huge laggard at the bottom of all the performance tables. So the performance has been kind of focused, but when you get these washouts and these big oversold conditions, you can sometimes see some pretty aggressive bounces, which can translate into some buy signals.
Yeah, I mean, I think that movement for cash and commodities in the Dolly rankings is certainly. I mean, cash had been ranked first or second in the Dolly rankings since toward the mid-September of 2022. I mean, so even though we've seen other areas in international equities move higher, domestic equities move higher, right? I mean, cash held on to that strength for quite a while now, almost 3 months, or just a little bit over 3 months there, or 6 months rather. And so then we saw that strength deteriorate. We have commodities back up into the second position. International equity still firmly in the top. But that deterioration in the cash strength is definitely going to be another area that we're continuing to keep an eye on. Therefore, it's a lot closer to domestic equities there in that fourth position. So definitely going to be a lot to look at over the course of the second quarter this year.
Yeah. Yeah. Well, that's nice, Ian. Anything else for the people?
No, I think that'll do it for number 899.
899. Awesome. Well, thanks everybody for tuning in this week. We appreciate the listen. We also appreciate all the feedback that you can give us about podcasts, about our reports, whatever it may be. We're happy to help. But until next week, thank you, and we'll see you then.